Hello there. Welcome to our session on financial performance. Whenever we have a discussion on corporate financial management or financial analysis and management, one of the things that we need to understand is that it's a fundamental objective of business to maximize shareholder wealth. That's what business is all about. Businesses are set up to maximize wealth for the shareholders. Nowadays, we also refer to this in terms of maximizing shareholder value, especially when we are talking in terms of listed companies. Now, what does shareholder value depend on? As we shall see in future sessions, the two most important criteria are, of course, sustainable business cash flows and well-managed risk. If the business can show current and potential investors that they have in place strategies that will actually help to sustain the business cash flows and profitability in the long term, then that is a good investment. This is why in the current international integrated reporting framework, the emphasis on reporting is now shifting from talking about past performance and moving on to future capacity to build value. However, what the business has done is a very strong basis for what it can potentially do. And so, 5 key areas of performance that we need to measure: what the company is doing now, what it can do potentially in the short term, medium term, and long term, then become very useful. The 5 key areas are, first of all, at what rate is revenue and profit generated? The statement of profit or loss tells us how much profit is made, but it does not give us information about the rate at which this profit is generated. And then the other survival criteria, if you like, is liquidity, is the ability to settle current liabilities on time. And thirdly, we will look at working capital management. Fourthly, we answer the question if the company has borrowed safely. And finally, we will look at investor or shareholder returns, what they would expect. Now, if we are going to talk about sustainable cash flows, these must be a function of profitability. Well, profits are generally the surplus of revenue over costs. But if you want to measure the rate at which profits are made, then there are two approaches to look at this rate. One is to find out how much profit is made for every dollar of sales, that is ability to generate revenue, where we take revenue over total assets. And the other one is the ability to generate profits for every dollar invested in the business. So that would be profits over total assets. But before we get to that, we often also measure margin. Margin is operating profit over revenue or net profit over revenue, depending on whether you want to work the margin at an operating level or net level. The word margin generally means something divided by revenue. So you see, once we have got the ability to generate sales and the margin of how much profits we take out of sales, we can bring that in and discuss the return on investment or return on assets. On the stock market, ROI means something slightly different from ROA, but for the purpose of financial analysis, we can take them to be synonymous. So ROA, return on assets, or ROI, can again be measured at two levels, either at operating level or net level. At operating level, it is called operating ROI. At net level, it is called net ROI. Now, net ROI is the overall measure of profitability. Any intelligent businessman would want to know, for every $1 that they give into the business, how much profit can they get? That's what ROI is all about. Now, this profitability depends on two things. Firstly, it depends on the ability to generate sales efficiently. That's measured by asset utilization. And secondly, it depends on how much profit the business can squeeze out of every dollar of sales. And that's where the margin comes in. So you will see that these 5 ratios together give you a good idea of the profitability of a business. Then we move on to liquidity. Liquidity is ability to pay your bills on time if you're a business. Well, technically speaking, we could say it's the ability to settle current liabilities on time. And the general rule is that the business must have $1 of liquid assets for every $1 of short-term liabilities that it has, or as we call them, current liabilities. Liquid assets may be defined as the cash and cash equivalents plus accounts receivable. So basically what we are saying is that a business pays its bills out of the cash that it has plus the cash that it's going to collect from its receivables, and that makes a lot of sense. So if a business has cash of about 30% and the accounts receivable is about 70% to 100% of the current liabilities, then you have comfortably a dollar for dollar matching of your liquid assets to current liabilities. Now, another ratio that is often used is the current ratio. The current ratio is not just a liquidity ratio, it is also a ratio of working capital. It's important to understand the meaning of working capital in this context. Of course, this word means slightly different things under different context. For example, if you are talking about the statement of cash flow, working capital basically refers to the balances of accounts receivable, inventories, and accounts payable. But for the purpose of financial analysis, the best definition of working capital would be the long-term money used to finance current assets. That's what it is. The long-term money, of course, includes the share capital and reserves, bonds, debentures, loan stocks, and any long-term borrowing from banks and third parties. The rule here is that working capital must always be positive. This is why you often see accounting textbooks saying that current assets must be greater than current liabilities, and then we say working capital is positive. That's because part of current assets must be financed using long-term finance. This provides stability and sustainability. And current liabilities is simply another name for short-term finance. So the wisdom here is that if you have some long-term finance financing your current assets, your ability to meet liabilities in the short term and the sustainability of the business in the long term is well assured. So long-term finance, once again, should be used to support investment in non-current assets and part of current assets.